Big update just dropped. On 25th July 2025, PTTEP, one of Thailand's biggest oil and gas giants, announced their second quarter 2025 results. And yes, you can buy it right here in Singapore. How? Through TPED, a Singapore Depository Receipt on SGX, meaning you don't need a Thai brokerage account, no foreign currency hassle, but you still get exposure to their juicy dividends. In this video, we'll break down PTTEP's business, the latest numbers, dividend history, valuation, and whether this is a buy or hold for Singapore investors. Stay till the end. I'll also show you how Thailand's dividend tax affects your net yield. Before we jump in, smash that like button so more Singaporeans can watch this, and subscribe to Wealth for You for more practical, no BS investing ideas. Disclaimer. This video is for education and entertainment only, not financial advice. Always do your own due diligence before investing. Chapter 1. What's an SDR? Quick crash course. An SDR, or Singapore Depository Receipt, is basically a Singapore-listed wrapper that represents shares of an overseas company. Think of it like this. Instead of going through the hassle of opening a foreign brokerage account and dealing with Thai baht, you can just buy the SDR on the SGX in Singapore dollars during our normal trading hours. For PTTEP, the SDR ticker is TPED on SGX. Each SDR is backed by the actual underlying PTTEP shares in Thailand. So when the Thai shares move, your SDR moves too. Best part? You get the same economic benefits, including dividends, credited to your account in SGD, after deducting any applicable withholding tax from Thailand. Chapter 2. PTTEP's business. So, who's PTTEP? Full name: PTT Exploration and Production, Public Company Limited, majority owned by PTT, Thailand's state-owned energy giant. That means they're not just any oil and gas player. They're the national champion in Thailand's upstream energy sector. Their core business is exploring, developing, and producing petroleum, with a strong focus on natural gas, which makes up about 70% of their output. This is no small detail. Natural gas is a cornerstone of electricity generation in both Thailand and Malaysia, making PTTEP critical for the region's energy security. One flagship asset is Block A18 in the Malaysia-Thailand Joint Development Area. It produces roughly 600 million standard cubic feet of gas per day, historically split equally between the two countries. But here's the big news. As of July 2025, PTTEP now owns 100% of the shares in Hess International Oil Corp, which holds the 50% stake in Block A18 they didn't already own. That means PTTEP now has full ownership of that 50% block interest, a strategic move to secure more stable supply for Thailand in the long run. Beyond Thailand, PTTEP runs over 50 projects in more than 10 countries, from nearby Myanmar and Malaysia to Oman in the Middle East, and even ventures in Australia. Their global reach diversifies supply sources, but Southeast Asia remains their bread-and-butter market. If you want an easy comparison, think of PTTEP as a regional upstream oil and gas giant. Similar in business model to ExxonMobil or Chevron, but on a smaller Asia-Pacific-focused scale. They're big in their home region, but not a global supermajor. And that focus could be both a strength and a risk, depending on where energy markets head next. Chapter 3. Q2. 2025 Results. All right, now for the juicy part. PTTEP's latest scorecard for the quarter ended 30th of June 2025, announced on 25th of July. The headline number? Net profit came in at USD 408 million. That's a 38% drop compared to the same quarter last year, and about 16% than Q1. The main culprit? Softer crude oil prices and slightly higher operating costs, But it's not all doom and gloom. Sales volume actually rose to 504,772 barrels of oil equivalent per day, up 4% from the previous quarter. This was mainly driven by stronger production from their core Thai fields, a sign that the operational side is still firing well. On the pricing front, the average selling price slipped to USD 44.01 BOE, down 6% year-on-year. This was in line with weaker global crude prices during the quarter. Costs ticked up slightly, with unit costs at USD 31.1 per BOE. That's not a huge jump, but enough to put a bit of pressure on margins when prices are falling. Financially, the balance sheet still looks solid. PTTEP is sitting on USD 3.48 billion in cash, with a debt-to-equity ratio of just 0.24 times. Their borrowings are mostly long-term, and the average interest cost is a low 3.94%, giving them plenty of breathing room in a higher-rate environment. So, in short, profits took a hit, but production is growing, costs are under control, and the financial footing remains strong. Chapter 4. Valuation Check. So, is PTTEP a bargain, or are we paying a premium right now? At today's prices, the company's market cap sits at around 600 billion Thai baht. That's roughly 22 billion Singapore dollars in our money. For context, that makes it one of Southeast Asia's largest upstream oil and gas players. The PE ratio is about 7.7 times, which is on the low side compared to many global oil majors that often trade in the low double digits. The price-to-book ratio is around 1.1 times, meaning the market is valuing it just slightly above its net assets. Return-wise, the ROE sits at a healthy 14%, showing they're generating solid profits for each dollar of shareholder equity. And here's a bonus. Their debt ratio is low, so they're nowhere near drowning in borrowings. All in all, valuation-wise, PTTEP isn't priced for perfection. You're not paying a frothy growth stock premium, but it's also not a deep bargain basement deal. It sits somewhere in that middle zone, reasonably priced for a steady energy player with a strong balance sheet. Chapter 5. Dividend Deep Dive. All right, dividend lovers. Here's the scoop on PTTEP's payouts. First up, PTTEP has a good track record of paying dividends twice a year, an interim mid-year and a final after the year ends. In Singapore dollar terms, the trailing yield works out to about 4.8%, and if they keep payouts steady, the forward yield looks closer to 5%. Their payout ratio is roughly 60% of earnings. That's well within the comfort zone for an oil and gas producer. It leaves them some room to reinvest in new projects while still rewarding shareholders. Now, the real question: is the dividend sustainable? This is where free cash flow comes in. Think of free cash flow as the cash left over after PTTEP pays all its operating costs and capital spending. That's the pool of money they can use for dividends, debt repayment, or new investments. Over the past 3 years, PTTEP's free cash flow has been solidly positive and more than enough to cover dividends. But in the second quarter of 2025, we saw some pressure. Higher capital spending meant less surplus cash. This isn't unusual in oil and gas, where project investments can be lumpy. But it's something to watch if oil prices stay weak. One last thing for Singapore investors: the Thailand withholding tax. Dividends to foreigners get clipped by 10% before they reach you. So if PTTEP's forward yield is 5% gross, after tax, you're looking at about 4.5% net in your Singapore dollar account. Still a healthy yield. Just don't be shocked when the number that lands in your bank account is a little smaller than the headline figure. Chapter 6. Critical Take. So, how did the second quarter really shape up once you peel back the headlines? On the operational side, there's good news. Production was up. Output climbed by 4% compared to the first quarter, driven mainly by stronger volumes from their key Thai fields and steady contributions from international projects. That's a positive sign that their core assets are still delivering. But it wasn't all smooth sailing. Costs crept higher. Unit production costs rose to $31.10 per barrel of oil equivalent. In an industry where margins are closely tied to commodity prices, even a small cost increase can sting when prices are falling. Speaking of prices, the average selling price slipped to $44.01 per barrel of oil equivalent, about 6% lower year-on-year. This was largely due to weaker crude benchmarks in the quarter, and that naturally dragged down revenue. Financially, though, PTTEP is still in a strong position. They're holding $3.48 billion in cash, with low debt and long maturities, so liquidity isn't a problem. There were also some one-off hits. They took a small write-off on a Mexico project, reflecting a reassessment of its future potential. On the flip side, their Middle East operations helped cushion some of the weakness from lower Thai gas prices. And one more factor: currency swings. With earnings in US dollars and costs in multiple currencies, exchange rate movements chipped away at profits this quarter. Bottom line? The second quarter wasn't a disaster. It was a mixed bag. Solid production growth and strong cash reserves are the bright spots. But higher costs, softer prices, and some non-cash write-offs kept the results from really shining. Chapter 7. Future Prospects. Looking ahead, PTTEP has a few interesting cards to play. The biggest growth lever right now is its expansion in the Malaysia-Thailand Joint Development Area, especially with the recent move to fully own Block A18, which is a key gas supplier for both countries. They're also working to keep production in their core Thai fields stable, which is crucial because these fields still make up the bulk of their cash flow. Of course, the oil price is the elephant in the room. If prices stay soft, earnings and free cash flow will come under pressure. But here's the thing. PTTEP's low debt, strong $3.48 billion cash pile, and disciplined capital expenditure give them plenty of breathing space to ride out volatility. They're also geographically diversified. Projects in the Middle East, Malaysia, and Australia help reduce reliance on any single market. If oil prices rebound or stay firm, PTTEP is well positioned to benefit. But if prices dip further, expect the share price and the dividends to feel some heat. Final thoughts: buy or hold. If you've been wanting Thai energy exposure without the hassle of opening a Thai brokerage account, TPED on SGX is a really neat option. You trade it in Singapore dollars, collect dividends in Singapore dollars, and avoid the foreign exchange conversion headaches. So, what's my verdict? With about a 5% forward yield, a rock-solid balance sheet, and a low price-to-earnings ratio of about 7.7 times, PTTEP offers good value for patient investors. If you already own it, hold and collect the dividends. If you're new and like the oil and gas sector, consider buying slowly, maybe on price dips. Just keep in mind, this is still an oil and gas play. Prices will swing, and so will the stock. If you're in for the long haul and can stomach some volatility, PTTEP could be a steady income contributor in your portfolio. If you enjoyed this breakdown of PTTEP's second quarter 2025 results, give this video a big thumbs up so more Singaporeans can watch it. Subscribe to Wealth for You, and don't forget to press the notification bell so you never miss another practical, no-nonsense investing video. Thanks for watching, and I'll see you in the next one.